One of the many benefits of being a Mott's Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the halftime report is Melissa Mott's, president of Mott's Wealth Management. She has over 30 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on July 26, 2017.
Thank you everyone for coming. Welcome to our halftime report. I can't remember how many of these we've done, but we've been doing them for a while now. And our next event is going to be our forecast event at the beginning of 2018, so we'll keep you informed. That'll be in February. If you're interested in introducing us to someone who can't come to an event like this, please let me know. We could do a personal lunch or dinner, something like that with them and you to meet in a nice, comfortable social setting. And I want to say shout out a special thanks to our sponsor and guest speaker this evening, Dave Fiorito from Delaware Funds in the back. Thanks, Dave, for sponsoring the event. You know how we get a lot of data in like from the news and different sources and so forth? So we're going to have a little fun with some data here. So what is the data telling us? So the data here, all the different colors in the different states. Look at the source. Can you read that from where you are? American Veterinary Association. So what is this data telling us? Something about pets. So in terms of raw population, cats outnumber dogs as pets. And you can see, just because cats are more compact, you can have more cats in a house than you can dogs, especially big dogs. But you can see here the states, so the light purple and the dark purple have more dogs, and the blue-green and the green have more cats. So you can see it's more in the South. They have more dogs. And that makes sense. I know there are a lot of dogs, like the rescue dogs and so forth, will come from down south. A lot of them will come up. But more cats in the north, the west, and the northeast. All right, so now we have another. What is this data telling us? So we can see all the states here and the sightings per 100,000 people. And this the sightings of what? I want to point to you. In the morning, the sightings aren't very high, but when they're during drinking hours, they're very, very high. And then sleeping. Who said UFOs? You got it, UFOs. So apparently Friday nights especially are a big UFO sighting. I got stuck by UFO. Yeah, I'm just picturing people like they're saying here, sitting on their porch, looking out at the stars, on their fourth or fifth beer, and it's like, whoa, look at that, there's a UFO. Okay, so now this data. So you see every state has a country, and it's talking about GDP in the millions. Any guesses on what this data is trying to tell us here?
Immigrants.
That's what I thought too when I first looked at it. Immigrants, no. What? Trade? No. All right. I can tell you're all in suspense here. It's the same size economy as a country. So, for instance, like France and California have the same size economy. So, Pennsylvania, Turkey, same size as Turkey. New York, same size as South Korea, and that includes New York City too. So it tells you South Korea is pretty big. And Texas, which is a big economy. Canada is the whole country of Canada, the same size. So it just goes to show you how, prosperous our country is. In all these countries in the world, it would take to equal the same economic size, GDP. All right, and here's the last one. So what is this data telling us? We can see it's in dollars. It's probably hard for you to see. But in dollars, we've got California, $88, Pennsylvania, $101. It's the relative value of $100. So in other words, the real purchasing power in Mississippi is 36% greater than it is in the District of Columbia. So it's going to take $68,000 in Washington, D.C. to buy the standard of living you get for $50,000 in Mississippi. Yeah. So, and Pennsylvania is like 101. So Pennsylvania is pretty average, I would say. Even though certain areas of Pennsylvania are more expensive than others for sure. All right. So now some more data here. So we can see how the S&P 500 has been doing, which is, one measure of stocks, top 500 companies in the U.S. It's actually a little bit higher now. This was June 30th. So it's slightly higher right now. But you can see we had our bear markets here, and then our march up. I heard a comment today, and I think it's true. When you have corrections or bear markets, they're like an elevator, right? You think of an elevator dropping quickly. And, when we're in expansions, it's more like an escalator. It takes time to, wind its way up. And then this is another slide I like to show, because what this is showing us is all these red dots are the maximum down in the market during the year, okay? So you can see, like, for instance, a year, like, I'm thinking this was in 2013. It was down 6% at one point, but it ended up 30. It was down here, this would have been 2015, down 12%, but it ended up down 1 at the end of the year. Here was down 11 in 2016, but ended up 10. So this is for the S&P 500. So you can see there are many more years of gains, of ups in this time frame back to 1980 than there are years of downs where it actually ends up down for the whole year. But every year you got drawdowns in here. You got lows. But they never, the one that got closest would have been here. This would have been in 2008, where the max down, I think it says 49%, and ended up down 38. But typically it ends up being a little better. Then this is bear markets. You see we had some long stretches here without too big. This red line here means it's gone down enough to be a bear market. If it goes past this red line, that's a 20% decline from the high. That's what we call a bear market. That's a significant correction. So if you go back from the early 80s all the way up through 2000, you've only got one, and it just barely went under and came back pretty quick, I mean, it's still painful as it's happening day by day, for sure, not to minimize that. But we've had a long stretch in there where we didn't really have a huge decline. Now, since 2008 and 9, when things have rebounded, we had another time in 2011 when we just barely touched it into the bear market territory. And here we can see our volatility pretty low right now, pretty low. But it doesn't mean we're going to be due for one, okay, for sure. Doesn't necessarily mean that, and we'll talk about that a little more. So here's another chart that shows us when interest rates for 10-year treasuries, when their yields are, when it's below 5%, okay, and interest rates go up, the stock market goes up. Because a lot of people are worried about that. If interest rates go up, what's going to happen to the stocks? Well, in that environment, pretty much stocks will go up. But when the 10-year treasury yield is over 5%, which we haven't seen that in a long time, and interest rates go up, then the stock market goes down. Okay, so, that's not a bad thing for where we are right now. This is a real long term, back to 1900, how things have gone. We can see we've passed the 2007 highs. We got up here was 2000 highs, and then we got back up to it again in 2007. Now we've passed it. And a lot of people are saying, when you hear things on the news or you read things that, oh my gosh, we're due for a big correction, things like that. But we've gone for long periods where we haven't had really big corrections too. So, and this slide shows the strength of our economic expansions. And this slide shows the months of economic expansions. So you can see our current one up through June is 96 months. The longest one is back here. And we've exceeded that. We haven't exceeded the second longest one yet. So a lot of people are saying, oh, this has gone on too long. We've got to have it come down and so forth. But the thing I want to point out is, look at the steepness of the expansions. Okay, they're steep. They went up quickly. Look at the one we're in now. It is gradual, very, very gradual. So the fact that it's going on for a long time because it's gradual is not a bad thing. That's a good thing. Okay, that means we still could have some room to run there. Okay, because typically when you have a major correction or a recession, you know, even the word recession, you're receding from something. You know, you're receding from things growing too quickly, too fast, and then it has to come back down. We're not growing too quickly, too fast. You know, we're in a very steady growth pattern. So, and then I wanted to touch a little bit tonight about global fixed income, about international bonds and stocks and so forth. Because we have a fair amount in the portfolios right now for a reason. So if we look over here, and we look up here, I don't know if you can see those from where you're sitting. What it's showing is back in the end of 1989, 61% of all of the debt was in U.S. debt. So U.S. government, corporations, et cetera. Now, fast forward to 2016, 38.9, so 39% is U.S. And the rest is in emerging market economies and developed, countries beside the U.S. And you can see it just here. The purple and the blue is a much bigger portion than this is the U.S. here. So in order to be able to get to participate fully and diversify, it's important to have global bonds. We do have global bonds in our portfolios. So what this slide is showing, and I've talked to some people about this when we've met, these slides show how things have done in different countries in their local currency versus the US dollar. So we've had several years where the US dollar has been going up in comparison with the euro, in comparison with the yen, in comparison with many different currencies. So what tends to happen then is you'll have, like if we go back to, say, here. Okay, this is the international. Local currency-wise, up 5.9%, but in US dollars it was only up 1.5%. The currency exchange rate diminished the returns because we get them in US dollars. Okay, that's how they show up on our statements. Now things have flipped. Okay, now other currencies are starting to do better than the dollar. The dollar's coming back down some. So what that means is you flip it, okay, here the same thing, 7.9% gain in local currency, but 14% gain in US dollars. Okay, so it acts like an enhancer. Before it was a suppressor, now it's acting like an enhancer. So that bodes well for having money in international stocks and emerging market stocks when the dollar is, cutting back. Oh, and the other thing I wanted to point out too, what this chart shows is the higher up here, the more closely assets are correlated. What that means is Spanish bonds, US bonds, Italian stocks, Japanese stocks. When the correlation is high, it means everything's moving together at the same way. They're going up together, they're going down together, up, down. So it's really hard to get benefits from diversifying a portfolio by having it in lots of different things because they're all moving together, We're seeing that go down. The correlations are coming down. And what that means is that you can get, you can remove some of the risk. You can reduce some of the risk in your investments by diversifying in different countries, as far as their stocks and bonds and so forth. So that's a really good thing. And then this slide shows, so the gray line is the US stock market. The purple is without US, so global stocks without US at all, so no US in there. So we can see this goes back to 1997 when they were about the same. US outperformed, okay, and then came down. And then the most recent one here, 2008-9, you can see they all came down together pretty much. They were together at the top, then they all came down together. Then they were together up until about this point, and then US stocks did much better. International, not so great, okay? So what we have now is kind of like what we had here. They weren't together at the bottom, but you can see Europe and international stocks, emerging markets, they were like worse than the US, but then over time they ended up coming back about up to the valuations of US, and we're in a similar place right here. So if the US continues to go up, Europe, we should see a steeper increase. So that bodes well, for us having international. So just like here, this was a more gradual increase from here, but this was a steeper increase in international. So that's kind of where we are right now. Okay. And then in this slide here, what I want to point out is the fundamentals, we call fundamentals of the market, are really in place to pick up steam for international stocks. And we can see different valuations. Like this little diamond right here shows the valuation for US stocks, and you can see it's above the average. This is the range of values that we've seen over the last 25 years. So they've gone from here up to here. Here's where the average is right there. But you look at some of them over here, like Japan is way down here. Emerging markets are below the average. Europe is just slightly above it. So we definitely have more room to run here. And another thing about this too, which you'll see in another slide, is unemployment in Europe has come down a lot, but they still have like a 9% unemployment rate. Does anybody know what the unemployment rate is here?
4.4.
Yeah, 4.4. So that's part of the problem, with our new administration in the White House and so forth. We're going to get GDP growth back up to 3%. Well, you have to have workers. You've got to have people to work and to expand businesses and to then spend their money and so forth. But we don't have a lot of people to add into the workforce. Whereas in Europe, they do. They still have quite a lot, to come back. So this slide, main thing you need to know is the darker the green, the better. The yellow, not so good. Red, not so good. So this is the Purchasing Managers Index for manufacturing. And see all the dark green in here? This is all Europe and Australia. Euro area. Real good. Real good. Even Greece is over 50% here. So Greece is coming back too, which is good. But then, so that's another thing that bodes well for Europe. This is showing inflation, which we've had a very low inflation rate, but now there's room for what they call reinflation, where the Federal Reserve is raising interest rates gradually. And when they do that, this component, this is what it was like before 2008-9. We had a big portion of our returns were coming from inflation, big chunk of them. Now they're much lower percentage. So our returns could really go up quite a bit with an increase in interest rates and inflation. And then here we are, European recovery. We can see this is gross domestic product in the Eurozone is picking up. It was kind of flat down. Now it's starting to pick up steam here. So that's a good thing. You see credit demand there. So businesses are borrowing more money. That's always a good sign. They're reinvesting it into their businesses. And then this is the unemployment number I was talking about. It's been going down, but it's still at 9.3. It still has room to go down. They've got a lot more workers they can put to work. And the confidence is the highest that it's been in 8 years in Europe. And then this is emerging markets. We have emerging markets in our portfolios now as well. And what we can see here were the lows, earnings per share for emerging market stocks. This was back in 2008 and 9. See how low? So the blue is Asia. So the blue, Asia had come down. Now it's been back on the rise. It's done really well. This is Latin America. Latin America earnings per share are lower than they were during the financial crisis. I mean, what that means is the stocks, they've really been hit. So there's a lot of room for growth there now because they're starting to come back. And same thing with emerging markets without Asia. So other than Latin America and Asia, other emerging markets, there's a lot of room to go there. And this one I always like to show just as a, reality check. These are CD rates of return, 6-month CDs, $338 for $100,000. That's what you would earn in a year. Okay, versus back in 2006, it was $5,240. You'd earn over 5% a year. Okay, and interest rates are going to go up, but I don't think they're going back up to this. Not for a long time. Things would really have to change. So that's what forces us to take more risk and to be able to get the returns. You can't just put the money in the bank and get it. So that's just the environment we're in. And I think that's it for me. Any questions? Nope. So I hope everybody's feeling positive.
I hope you enjoyed listening to Melissa Motz, and if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motzwealthmanagement.com for the most up-to-date listing of these events. Over the years, many of our clients have asked Melissa to speak with a friend, relative, or colleague concerning private financial management. Melissa considers it an honor and a privilege and has been happy to accommodate those wishes. For your future reference, please be aware of the standards by which she complies with such requests. First, confidentiality is a cornerstone of our business. Each of our client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, Melissa will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send Melissa an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.